Thank you, Mr. Chairman, and it's good to see you again, Chair Yellen. I want to follow up on Senator Corker's question. As you know, Dodd-Frank requires big financial institutions to submit living wills, a plan for how they could be liquidated, and I want to quote the statute here, in a rapid and orderly fashion in bankruptcy without bringing down the economy or needing a taxpayer bailout. Now, by law, the Fed and the FDIC are supposed to determine whether these plans are credible or not, and then if they're not credible, the agencies can order the institutions either to simplify their structures or eventually to sell off assets. So last August, the Fed and the FDIC identified significant problems with the living wills submitted by 11 of the biggest banks in the country. The FDIC determined that these living wills were not credible, but the Fed didn't. Instead, the Fed said that if the banks did not, quote, take immediate action to improve their resolvability and reflect those improvements, close quote, in their new living wills, the Fed, quote, expected, close quote, to find the new living wills were not credible. Now, the 11 banks submitted their new living wills at the beginning of this month, and I know you haven't completed reviewing them yet, but I just want to make sure we're really clear on this point. Will the Fed find living wills not credible if the bank has not fixed each of the problems that the agencies identified last August?
We are certainly prepared to make those determinations. We will work jointly with the FDIC, as we have been doing, to analyze the living wills and see whether or not we feel that the responses to the directions that we gave to these firms are satisfactory or not. And if we find that they're not, we are certainly prepared to say that they are not credible.
Okay, good. I'm glad to hear that. Two of the issues the agencies directed the banks to address were, quote, establishing a rational and less complex legal structure and developing a holding company structure that supports resolvability. Now, J.P. Morgan Chase, just to pick one example, has over 3,000 subsidiaries. It will take a lot of work to establish a rational structure that permits J.P. Morgan to be resolved quickly as required by law. But to be clear again, the Fed will find J.P. Morgan's living will not credible and the living wills of the other 10 banks not credible if they have not taken concrete steps to significantly simplify their structures and are not sleek enough to be resolved quickly?
Well, we have given them those directions, and we will evaluate that. I would simply say that the regulatory reports that we receive indicate that these firms, since 2009, have reduced the number of legal entities in their structures by approximately a fifth. I guess we will be looking for...
You will note that number I gave you is not from 2009. It's over 3,000 subsidiaries at latest count that I've seen. So I just want to be clear that you're willing to say not credible if they don't meet the legal standards, that they could quickly be resolved, and that includes how complex their structure is.
Well, agreed that they need to be less complex, and we've given them that direction. But I'm not sure we can determine exactly how complex they are by just counting the number of legal entities.
Fair enough. I'm glad to have lots of ways you look at this.
They're not all equal. Some are, set up for very narrow purposes and are not really material parts of the, wouldn't represent serious impediments to resolving the firm. So I don't want to determine this by a count of legal entities.
Count by itself, I understand that, but we do remember that the statute says rapid and orderly liquidation, and that goes to the question of complexity. I raise this because the living wills are one of the primary tools the Fed has to make sure that taxpayers won't be on the hook if one of these giant banks fails. It is critical that the Fed uses this authority, and like the FDIC has been willing to do, to make our financial system safer. I want to ask you one other question, just quickly. In Dodd-Frank, Congress directed the Fed to impose some tougher rules on banks with more than $50 billion in assets. That covers roughly 40 of the biggest banks in the country, about 0.5% of the 6,500 banks that we have in the U.S. Together, this 0.5% holds more than $14 trillion in assets, about 95% of all the banking assets in this country. 40 banks, 95% of all the assets. The tougher scrutiny is designed to direct regulator attention where serious risk is. In other words, concentrate regulatory scrutiny on these 40 banks rather than on community banks and credit unions. Now, there have been proposals recently about exempting many of these banks from tougher rules by raising the $50 billion threshold to $100 billion, $250 billion, $500 billion. The argument I hear is that $50 billion banks just don't pose systemic risk. So I just want to ask a question on this one. We learned, or should have learned, in 2008 that in a crisis, several banks can find themselves on the verge of failure at the same time. Do you think it could pose a systemic threat if 2 or 3 banks with about $50 billion in assets were on the verge of failure?
Well, when a significant number of firms is at the risk of failure, often it's because they have highly correlated positions. We always have to worry about that's resulting in a drying up of credit to the economy. And, during the Great Depression, most of the banks that failed were small. They were a lot smaller than 50 billion or adjusted for that time. So when many banks fail, of course, we have to be concerned as well. And that's one reason why for all institutions, even for community banks, Basel III regulatory capital requirements are higher. We want to see safety and soundness throughout the entire financial system, throughout the banking system, although the most systemic firms, as you pointed out, of course, need the greatest scrutiny.
It's the top 40. So I just want to say there are 2 approaches to this issue. The first, which every Republican on this committee supported, is to raise the threshold to $500 billion. That is, cut loose about 30 or so of the biggest banks in this country and just hope for the best. And if it doesn't work out, the taxpayers can pick up the tab again. The other approach is to play it safe, keep the threshold where it is, and rely on the Fed to tailor the rules to fit the risks posed by these different banks. That's the approach I support, and since the American taxpayers are on the hook when the economy starts to implode, I suspect most of them would prefer that Congress be careful too. Thank you, Madam Chair. Thank you, Mr. Chairman.